Well, good morning. I have an official job title and an unofficial job title, my unofficial job title being Mr. Unpopular, because basically we're talking here about the increase in the cost of claims. And it feels like with every passing week, I have to persuade my colleagues in the ERS exec of why the job of defending claims and settling them and competitively is like responding to a tidal wave. What I wanted to do here was to just bring together the practical implications for claims from what we've heard so far. When we begin by talking about the discount rate, I think it's important to say that we unequivocally support the 100% principle, and we need to get that straight at the beginning. As Richard said, the 100% principle is part of common law, endorsed by the Lord Chancellor, that the person should be put back in the same position that they would have been insofar as the law and damages can allow. Yeah, no more and no less. Last year, we settled our largest ever claim. It was about £8 million, and I feel that was the best £8 million we ever spent. That really is what insurance companies are here for. So let's get it straight. You know, we are not here because we've got an issue with settling claims at 100%. The issue is how the discount rate was arrived at, because patently it is not the right amount. It does not reflect what people are able to achieve through investment. One of the immediate implications for this, as the Law Society Gazette reported, was a slowing down in claims. They were seeing that settlement offers were just not being made within 2 or 3 weeks of the announcement. And clearly, that is not a situation that you want when you've got catastrophically injured people. As it happens, we are finding that it is still possible to settle claims and to sort people's lives out so that they and their families can have closure on the matter and get on with things. When it comes to talking about whiplash, as Donna has pointed out, not only do defendants have issues with the proposed reforms, but also claimant representatives do as well. The implications of the reforms, by raising the small claims track limit, are to remove professional lawyers from representing, because costs are not recoverable in the small claims track, broadly speaking. But without regulation of currently unregulated entities, what we all believe will happen is that as professional lawyers move out, unregulated entities will move in, and claim frequency will probably remain exactly the same. Unfortunately, though, in the mind of the consumer, they will remember that George Osborne, in his autumn statement, referred to a saving of £40 per policy. Well, if frequency remains the same, I'm not sure that that is going to be realised at all. And let's be honest, nobody is quite sure where he got the £40 per policy from in any event. The other thing is that if unregulated entities move in, then they are going to be doing so, cutting deals with claimants to take a proportion of their damages. So it's a worst case scenario. We'll have the same number of claims and people being ripped off by unprofessional service providers. The other thing that I just wanted to share with you, for those of you who market legal expenses insurance, is this represents a complete dislocation of the legal expenses market. ARAG reckoned that it would put something like £15 per policy on a legal expenses insurance cover, which may currently cost about £20 to £30, and that's a dramatic increase. But of course the reason is that the costs cannot be recovered by a professional representative. So something is going to need to change, whether or not it's the premium dramatically increasing or the service decreasing. We could turn around and find a world where in a couple of years' time, what you actually get from a legal expenses insurance policy at £20 a shot is the opportunity to ring a helpline who will help you to fill in your claim form and wish you good luck, because that's all that £20 a policy can buy. So we have reservations that the whiplash reforms will deliver a saving. The other thing that we're not going to spend time talking about this morning, but which already exists as a phenomenon, is repair inflation. Now, many of you will be familiar that increased technology in cars is causing the cost of repairs to go up, but also the effect of the depreciation of sterling post-Brexit means that because the majority of parts and paint are imported into the UK, repair inflation, according to Auditex, which is the industry standard estimating tool, is running at 8.25% on vehicle repairs. So you've got 8.25% going into your first-party claims, and of course, because some of those are subrogated as third-party claims, you've got the 8.25 coming back in third-party, and that's before we consider the effect of Ogden and whiplash on personal injury. So I talked about the tidal wave facing us earlier. I think the only person who could believe that you can combat them, that would be a guy who died in Anglo-Saxon times, who was of course called King Canute. So in terms of the implications of that for underwriting and pricing, I'll now hand you over to Gina.
Hi, good morning. So I get the lovely task of trying to translate everything that everybody's just said into some actual numbers for you to try and give you a feel for how your premiums might increase going forward and to try and give you a flavour for how you might want to explain that to your customers going forward. It's just one more slide. Right, so this is quite a busy slide. I don't know if you can all see that. So we're just going to take it one by one. So obviously you've heard about the Ogden discount rate, which has quite a substantial effect on the pricing going forward for those larger claims. So what we've done here is taken a standard everyday vehicle car, and we've also taken a standard sort of commercial vehicle risk. So taxi being a good example. So the first one, we're just assuming current premium, £300. The commercial vehicle, we're assuming it's a £2,500 premium. So that's your starting point based on what we would have priced, say, at January this year. So the Ogden discount rate, obviously we need to pass that on to the consumer. That, in our approach, would give rise to something like a 7% increase in premium on the standard everyday vehicle and a 13% increase for a commercial vehicle. It will vary by risk though. So for example, if you're writing a classic car that's laid up in a secure garage for 10 months of the year, only comes out 2 sunny months hopefully, the price rise is probably going to be a lot less than 7%, between 5 and 6. Obviously, for those risks that are greater exposed to bodily injury claims, so for example, a minibus risk that's carrying a dozen school children, the exposure is much greater and the price is going to be much higher. So that 13% isn't going to cut it for that type of risk and would be a lot higher, something like 20-25%. So the exposure and the pricing does obviously change. So that's one thing to explain. So you've just heard about the IPT hike as well, so the third change in something like a year. That is going to be passed on to the customer, so that's a 2% increase across both our risks according to the way that we would approach it. These are obviously just illustrative examples. And obviously a higher premium, higher proportion, higher cost to the consumer. You've just heard Martin talk about the increased reinsurance costs, mostly driven by the Ogden issue that we've been talking about. So that would apply something around 5% increase for the standard everyday car and something around an 8% increase for a commercial driver. Again, depending on the risk, that could be greater or lower. Claims inflation, so Peter obviously has mentioned this is, the underlying increase in repair costs and replacement vehicle values. So a 5% assumption really is what the industry would be seeing at the moment. So that's another addition to the premium going forward. And the last thing, which hasn't actually been talked about much today, is the Vnuk Judgment. So some of you may be aware that there was an ECJ ruling on a Slovenian gentleman who was injured by a tractor on a private property. He was seeking compensation and he went all the way through the courts, and the court ruling that occurred basically means that compulsory insurance could be required to cover all accidents involving a vehicle's normal use. So that includes cars driven on private property. So that's another thing that is emerging that is going to add more cost to the premium. There was actually an interesting case that just came through, which was UK insurance against Holden and Phoenix. So this is a situation where there was a car laid up in the bay of a factory that was being worked on. So it was jacked up, the battery was disconnected. One of the factory workers was doing a bit of welding on it just to fix something. The factory caught fire. It was a £2 million property risk. The courts actually ruled in favour of the property insurer, and so the RTA motor insurer has picked up that claim, which is an interesting outcome. So the application of what is normal use of a vehicle could be quite wide, and will be interesting to see how that develops. So you can see that that's something else that insurers need to be aware of. So what does that mean? There's an awful lot going into the premium increase going forward. So for a standard risk, based on just some of the illustrations that we put here, that's an increase of about 20%. That's quite hard to explain to a consumer who's expecting a reduction on renewal because they haven't had a claim. And obviously on a commercial risk, that's something like 29% increase. And it could be more or less depending on the risk profile of the risk being written.